So, big news flash. If you've been living under a rock, we're here to tell you that the Bank of Canada did the thinkable, and rates have now come down by 25 basis points, bringing us down to 2.5% on the overnight lending rate. So, lots to unpack here. My name is Ralph Fox, and I'm the co founder and broker of record of Fox Marin. And today we have friend of the pod, none other than Jason Friesen, managing partner at Outline Financial. Jason, so great to have you here.
Always a pleasure. Love coming on the pod.
Amazing. Well, let's talk about this, Jason. Like, there's been a lot of lead up all summer. It's been kind of a quiet summer, but there's been a lot of discussions about the economy, unemployment, interest rates, especially a lot of chatter out of the U.S. with Fed independence. What's happening? What got us to this moment?
It's been definitely a roller coaster throughout the summer. There were questions if they would cut again this year, and now the question is by how much. So definitely positive news is from an interest rate perspective, seeing that quarter point cut. And I think obviously the Bank of Canada is going to be, cautious when they move forward. But, most economists are forecasting another cut by the end of the year. Some are calling for maybe another 50 basis points in cuts. I think we look at October 29th as the next rate announcement. So we've got about a month and a half. It's really going to be data dependent. I think, seeing inflation come in a little tamer than expected was the final, kind of nail in confirming that, yes, rates are going to get cut. I think yesterday the market was pricing in like a 95% chance of a cut. And we were talking earlier, it was weird. RBC was the only big bank calling for a hold. That's strange. I think, again, looking at what the forecasts are, we've got the banks forecasting another 25, BMO's expecting another 50 by the end of the year. It's all positive news, obviously, if you're a variable rate, holder on your mortgage or you have a line of credit. Also, I think just, after sitting on the sidelines for 3 meetings in a row, seeing them move to cut. And obviously we do have a Fed announcement later today. I think it starts to trend rates in the right direction. And again, looking back over the summer, there were some moments in time where we were wondering if we would see another cut this year. So definitely positive news.
So much for higher for longer.
Yeah.
It's so interesting because I'm just thinking as you were talking about all these different slogans, like we're not even thinking about raising interest rates till 2025. We all know what happened. It's transitory. Don't worry about it. This is all going to pass through the system. We all know
borrow money. It'll be cheap for a long time.
Yeah. And then higher for longer. And we all know where that one is going to end up as well. So I think there's so much to talk about. So interesting how we could shift from a 25% chance of a rate cut all the way up to 90%. So this rate cut really wasn't much of a surprise in Canada as well as in the US. Consensus was extremely strong that this was going to happen, but this shifted really, really, really quickly. So why do you think we had that big of a shift from the summer to where we are now?
Last couple months, bad job numbers, most recent quarter GDP contraction, seeing a huge contraction on exports. Pretty significant amount, and then seeing inflation still on the high band of where the Bank of Canada would like to see it, but within the range. So those three things happening over the last month all solidified this cut happening. Previous to that, I think we go back, we talked about it on the last podcast about the US job numbers artificially looking fantastic for the first part of the year before all of those downward revisions. And now I think we're seeing a slowdown both sides of the border. And, that shifted the conversation pretty quickly on the Fed side as well, which then opened the door also for the Bank of Canada to potentially be a bit more aggressive as well.
We saw 900,000 job revision.
Crazy.
In history in September. Like the magnitude of a revision that size, it's pretty
massive.
Hard to fathom.
Yeah, absolutely.
And that was after Trump had, but I guess it was the work. But Trump did fire the head of the BLS,
labor statistics. I think,
out of the U.S. But I think this is part of a much bigger trend, and there's a couple things to look at. Like if you look at what's happening in the U.S., the U.S. administration has been screaming for cuts for a while. They're going to get their cuts one way or another. A key marker to keep in mind is this May, when Chairman Powell out of the Fed has to resign. And going back to some of the predictions, if you look at BMO, not just in Canada, at 75 points, they're calling for a reduction between basically today and the spring of 2026. But if you look at what they're saying about the US, they're calling for 150 basis
Mm-hmm.
points. So it's really interesting to sort of look at, all of a sudden everyone's freaking out about unemployment, but also it's different because they're running at 3% GDP growth. We're here, we're down a percentage point, one point
Mm-hmm.
something percent,
1.6, going 0.6.
1.6,
Yeah.
yeah,
Yeah.
over Q2. So it's interesting to see they're running a lot hotter. And it's such an interesting thing to really think about, where you have the stock market at all-time highs, you have commodities at all-time highs, but you have employment falling off the
Off a cliff.
table, literally, and yet you have them cutting into rates. Like, this is a very unique time, and I think the one thing that people really aren't thinking about long term is how AI is affecting all of this. Jason, do you have any thoughts on that?
I haven't really dove that deep into the whole AI thing. I think it's
Right.
something obviously that is going to, even in our business, it's something that we've started to adapt.
Mm-hmm.
And it will, it is going to take jobs away. It's also going to make our jobs, I think there's lots of jobs that are still going to be fine and always be needed, but the way we do business is definitely going to change. It does seem like Canada has been a little slower to adapt. Even just looking at like labor productivity and things like that. I think Canada has been falling behind the other G7 countries for a while, and so hopefully Canada is able to kind of change their luck with that and turn things around. But I think it's there's been some bad signs in the Canadian workforce for a while, and yeah,
But you're also seeing it in the U.S., where you have a strong
yeah,
economy, and so
yeah,
what I think is happening, and it's partially what we're seeing as a result in the stock market, is that companies are becoming more efficient with these cuts. And if you look
yeah,
at where a lot of the cuts are happening in jobs, it's in youth employment, it's in low-level wage employment. And those are the first that are going to get cut, redundant type jobs, which AI could more
can be
easily replace.
automated quickly. Yeah, absolutely.
Exactly,
Yeah,
exactly. So you
yeah.
have companies operating more efficiently, showing higher profits,
Hmm.
while at the same time we're shedding jobs. And one of the things that was really interesting between the Fed and the Bank of Canada is the Bank of Canada really has one mandate, which is to manage inflation,
Inflation.
but the
Yeah.
Fed has a dual mandate, which is inflation and it's unemployment. And what's interesting, if you just look at the language that's come out of the Fed more recently, is they're talking about shifting their priorities, moving away from inflation and moving towards managing unemployment. And I think what you're going to see, and it's one of the things I've thought and read a little bit about, is this 2% narrative of inflation. It's something that's been standardized, but nobody really quite knows why. And I think when they look at the choices as AI and efficiencies come into the economy, they're going to have this choice, which the Fed is openly now talking about, between unemployment and inflation. And one of the other things that's interesting about the AI conversation with regards to the economy is that by nature, technologies like AI, which is literally going to reshape everything, are deflationary. And so if you start to zoom out over the long term, AI is going to be very deflationary. And I think the real problem is going to be the unemployment, especially at the lower levels, uh, which is actually going to have to be managed more skillfully, and a lot more thought is going to be put into this.
Hmm.
So I'm very much of the opinion that we're going into a very low interest environment. Also, taking in tandem, if you saw what happened in the US with the election and Doge, they're not doing any cuts. And so they're not bringing in austerity. And so they're very clear that they're going to run hot, and they're going to try and grow through AI and robotics their way out of the trap that they're in, which is huge deficits. And I think by nature, we're going to see the same thing here in Canada, not as much through investment in technology or into companies, because that might be a little bit too capitalistic here for Canadians. But we are going to see a financial bazooka, and look for the federal budget, hopefully coming out in November. And I think we're going to see a ton of stimulus and government operations basically pumping money into the economy. And so I think we're going to run a little bit like the way we ran as a case study in COVID, where you're going to see high employment. It's going to be mostly lower level jobs, at least for the foreseeable short term future. You're going to see a lot of money, a lot of cheap money moving through the system. And you're going to continue to see those with hard assets continue to do really well in a very bifurcated K-shaped economy. And I think that's clearly where we're going. And it's something that people really aren't talking about, especially in the media, where they're just sort of talking about, well, this may happen and this announcement and that. But if you really look at the big picture, I think this is clearly where we're going, to a low interest rate, high QE environment for the foreseeable future, with unemployment and a huge gap variance between the wealthy and
the haves and the have-nots, right?
yeah,
Yeah,
yeah.
yeah. It does seem like, even just in our business, I think in some ways, working a lot in the Toronto market, we're almost, the clients we work with, are all high income, dual earning, people that are able to purchase a house in the city. Obviously, it's, you have to have a pretty high income that you forget
Or
that.
from a wealthy family.
Yeah, yeah, yeah. That a
Thank you,
large
mom and
percentage.
dad.
Yeah. What's the average family income in the city? 70, 80,000 maybe.
Yeah.
And yeah, that doesn't qualify you for much of a mortgage. So you will see that greater divide between the haves and the have-nots. I think it's already been underway for quite some time.
Exactly. So
Yeah.
I think that's that's like, how do you see the next 6 months playing out?
The last 8 months of 2025 have proven that anything can happen. Just going to take it month by month, to be honest with you. Things change so rapidly. But it does look like we are definitely trending down from a rate perspective. Looking at that and how it relates to, I guess, Toronto real estate is going to be interesting. Obviously you've got, unemployment rising, but you've also got rates coming down. So for those that are not impacted by, and again, if you're talking about lower level income jobs, being, the ones that are hit hardest, are we going to see these lower rates start to potentially turn the real estate market around by people that are not impacted by, losing their jobs? So, as we've, shown the last several years, cheap interest rates are like drugs to some people. And, it'll be interesting to see what this does. Just even looking, I think looking over the last couple months, we've seen a small uptick in July and August, but interested to see on what this will do to people moving forward, if we'll see a very active fall market or not, and potentially busy spring.
Yeah, I don't think it's this cut in itself, but I think it's if the consensus and the narrative starts.
The narrative is the key. Yeah.
Yeah, it's the perception. And if the perception is more rate cuts, then that perception, I think, is more important to shifting the market up or down, based on what people are thinking we're going, versus this one cut specifically. But if we, as per the Bank of Montreal, which I think is correct, it might take a little bit longer timeline for all of this to play out. Maybe one more cut this year and another one in the spring. But let's say we get down to 2% on the variable, on the overnight lending rate. Like, where would that put the variable, and how stimulative would that be to the market?
For sure. You're going to start to see variable rates into mid to low threes, right? So, prime would be, if we're looking at the overnight rate at 2%, prime's at 4.2. So you're looking at variable rates are always a discount off of that. So depending on your discount, 3.5, kind of maybe, trending down towards 3%. I think that, the market's very healthy when rates are in the threes and even in the fours. I think it was a big challenge when we had rates that were in the fives and in the sixes. Yeah. Very challenging, from an affordability.
So quickly,
quickly. Absolutely.
While the price of everything up is going up
Agreed.
around it.
Agreed. And I would say I'm seeing quite a big, boost in activity over the last couple of weeks. Lots of clients reaching out. Um, you know, I am seeing clients, as they should be, more, very conscious of their budget
Yes.
and, being, unwilling to stretch themselves. And unfortunately, in 2020 and 2021, the way that the market was going, clients were putting themselves out and putting themselves in a situation where it didn't really give them any fallback plan. And I
Hmm.
really think now the budget is key. Clients are looking at it as, I'm going to stick to this budget. If I don't get the property at this price, I'm not going to buy it. I'm not going to get
Yeah.
into a bidding war. I'm not going to justify spending $100,000 more. Even if I can qualify or afford it, I'm not going to do it. So I think people are definitely more in tune with budgeting, as they always should be, and how I always kind of stress things. And I have my entire
That's
career is making sure, like, stick to a budget. Don't get carried away. Don't get carried away with the emotions. Get your pre-approval done first. Know where the numbers are, versus finding a house and then justifying to yourself how you're going to afford to pay for it, right? So I am seeing clients definitely move forward more cautiously. But, I, even prior to this cut, I think obviously leading up to it, we were expecting this cut to happen. There's a bit more optimism in the market right now. And I'm seeing, buyers move off the sidelines. I'm looking at a lot of buyers that are looking to move up, and maybe from their starter home to their forever home. That seems to be a big part of business as well. So I am seeing activity. It's definitely not 2020, 2021 activity, but I think things are trending in the right direction.
That's very, very interesting to hear. And are you seeing it in certain asset classes? Like, are you seeing it at certain price points? Like, where would you say you guys are seeing most of the activity, or is it spread evenly?
I would probably say that a lot of clients are maybe in that, starter home that's maybe close to $1 million, looking to get to
Yeah.
like maybe 1.4, 1.3, 1.4. Maybe they need some more space or a backyard, those types of things. But I've been seeing it across the board, but a large percentage of move up buyers are in that. Again, maybe it's a townhouse, maybe it's a small house, and looking to get to a slightly larger house, or maybe into a better neighborhood as well.
Yeah, there's a lot of people
Yeah,
out there
yeah,
who have been in their condos longer than they thought they would, and now
yeah,
have a child or children, and they're trying to figure out how they can get more space. And oftentimes
yeah,
the condo market just isn't there, and so that's a real big thing in terms of having those type of conversations. We are seeing a lot more interest in first time buyers on the condo side. There's a
yeah.
lot of interest coming
Me
back
too.
there. A lot of people
Yeah,
been living in their parents' basements or been renting, and their parents are like nudging them. Now's the time. But we're seeing it across the spectrum as well. And I do think that there's a bit of a shift. How much of a shift we'll have to see. As you and I know, things have been changing so much. You never really get too excited about anything anymore. It's always
yeah.
like we have a saying at Fox Marin: "We'll see, we'll
Hmm.
see." So I think it's another step in the direction of cheaper money. I think we're
Yeah,
inevitably going there, and how that impacts the market, I think will also be directly related to how much certainty we have in our future. There's still a lot of
yeah,
uncertainty with the trade deal that we don't have, and where that's going. So having a resolve to that in tandem with lower interest rates, I think would be really, really helpful. Parliament is now sitting, which is a good thing. We may have a budget soon. So, I mean, a lot of those things, just in terms of knowing that we have a functioning government and they're doing some of the things that a normal government would do. And there's negotiations with our largest trading partner, or something has been solidified. I think all those things would be really
yeah.
healthy, at least on a psychological level.
Getting back to talking about condos, and don't quote me these exact figures, I'm going by
Mm-hmm.
memory, but I think in 2023, at the start of 2023, the average condo price was around 743, I think, on Treb. And I think it's down close to 650 right now, somewhere in that range. And a combination of much lower interest rates and lower purchase price, the amount of income that you need to earn to be able to qualify for that is significantly lower. And then on
Mm-hmm.
top of that, the carrying costs are also significantly lower as well. So if you take someone putting 20% down on both of those, when I ran the numbers, I think it went from about 140,000 in income needed in 2023 to about 100 to 110,000 in income needed to qualify
Significant.
for that. Significant. And then on top of that, the carrying costs were maybe $900 less a month as well, based on that average price. So that's a pretty significant difference. I've had, to your point, more clients coming out of the woodwork looking at condos now that it is within range and affordable. That 140K in
More
income to qualify.
affordable. It's still
Yeah,
not affordable, but
still not
more
affordable.
affordable. It's
But what
definitely
it
more
also does,
affordable.
it starts to bring it closer in line with where rents are. With
Hmm.
rates being lower,
Yes.
it starts to, looking back in 2023 with rates being so high and the average price being so high, you know, it didn't make sense if you were looking at just your finances. Does it make sense to rent or buy from monthly cash flow perspective? But now it starts to bring those numbers a little closer together.
It's interesting. Corey and I were at a conference end of August, and one of the speakers was the CEO of Realtor.com in the US, which is the largest, I think it's the largest real estate site or platform in North America, if not the one of the. And he was talking about some of the data that they can see with their users. They get 250 million hits, unique hits or separate hits per month. So they have a very wide net. And he said what they're seeing is typically they would have about a quarter of users being renters. Now it's a third. And so they have
Oh,
an
well.
inordinately high amount of renters, but they're able, based on how they identify them, to track their behavior. And they're all aggressively looking at listings. And what he was talking about is part of the turnaround that they are predicting based on user behavior is they're seeing a lot of renters or people who have been on the sidelines, not identified as owners, looking at becoming first-time buyers. And they were saying that as a lot of the fear in the US around tariffs is starting to come down because they haven't seen the Armageddon that was predicted,
Mm-hmm.
that's dying out. That narrative is dying out, and rates are going to come down significantly in the US. They're seeing a lot of these people who've been sitting on the sidelines starting to get very active online, which is a predictor of future behavior. And I think that
Sure.
goes in line with what you're seeing, and we're seeing a little bit more anecdotally with
Mm-hmm.
talking to people and talking to clients. Is those first time buyers really seem to be looking to come out of the woodwork right now.
I think, maybe the, kind of first part of the year, people were trying to see if they could time the bottom, you know what I mean? And
Yeah,
wondering, am I going to sit in the sidelines?
true.
Now, I think with rates coming down, they're looking at it as, okay, did these payments make sense for us? Let's get into the market now, and so again, making sure it's obviously affordable, but that mentality has shifted to, we're just going to wait and see to actually, let's get out and purchase something now. Um, it seems to be, again, that renewed optimism has, we've started to see a shift in buyer mentality. And, I think it wasn't very, today we were expecting the cut. That was, and I've said to people, it's not what they do, it's what they say today, both in Canada and the US. I think that future policy on where rates are potentially headed, that will also grow some confidence on potential buyers as well.
It's so interesting because um, it's unbelievable how cheap relative to the replacement costs you can actually buy a condo in Toronto because costs are fixed to build. So and there is no more building happening, or the pipeline is about to stop at the end of next year. And so one of the things we talk about and think about a lot are think about long term. And if you look out long term, the pipeline of future condos is literally going to go to zero, and it will probably stay that way for about a decade by the time it takes to catch up. So you start to look at that, and then you're thinking about what the replacement is today versus what the replacement cost would be with everything continuing to go up with inflation and currency debasement, et cetera. And you're realizing that if it's $1,500 to rebuild something that you're buying for $850 today, and in 10 years,
Yeah.
that's 2200 before anything else. If you're just sort of, and I think people are starting to do that math, and it's just so interesting. We had a client working with someone on our team, and they bought a condo for, I think, like a studio, but in a really good location downtown in a great building for it had a three in front of it. It was like
Wow,
398,000.
crazy.
And what's so interesting is that I remember not too long ago, we had people coming to our team saying, yeah, I'd like to buy something in the fours. And we couldn't even find a condo just listed or had sold for under 500,000. And
Not in the
so,
core. You're looking
no,
really far out
yeah,
and
back then,
yeah,
yeah, which wasn't too far ago.
yeah,
So I think people are starting to see the value, and they're starting to think about affordability, and parents are giving them little nudges, and they're doing the math between renting and owning.
yeah.
And I think there's a palpable shift starting now. I know there's a lot of people presuming they've gone this far watching this conversation, but thinking, this market's not going to, we're not saying the market is going to turn around in 2 seconds.
No.
But we are saying that they're starting to see a large shift in the demographic that's been suffering the most, which is entry level studio and one bedroom condos.
Sure.
And if things continue in the path that we're seeing, I think we are going to see a significant uptick in buyer activity on the demand side in this type of product, which inevitably will start to help some type of recovery further down the line.
Mm-hmm. But I think it's like, if the numbers make sense and it's affordable, I think that's what people are looking at. Again, before it was trying to time that bottom. And I think that mentality has shifted. Rates have come down enough that it does make sense. And again, that balance between renting and buying is closer now. So people are looking at it as, I want to hold on this for at least 5 years, at a minimum. I'd rather be paying something towards a mortgage. Even if I get no appreciation, I am still getting principal pay down versus paying, a landlord $2,800 a month for a place, right? So,
Mm-hmm.
yeah, that's definitely been a shift. I'm curious to see, you know, what happens over the next couple of years with this lack of development. I think there's obviously still quite a bit more inventory coming
Yep.
online, right? And Ralph, what are you seeing for those places that are closing? Are you seeing a lot of those new builds being listed right away, or are you seeing those buyers that bought pre-con holding on to it for the time being?
All of our clients who had bought are still holding on because they see the longer picture, and there's no point at losing your HST rebate or
Yeah,
trying to sell at a loss, at a significant
yeah,
loss. So most people are hanging on, and generally, when you're in a new building, you have to rent out, competing against a whole bunch of other units, but they're not rent controlled, so they know once we return to more normal conditions, maybe in a year or two, they're able to see their rents go up, and hopefully 3, 4, 5 years down the road, be able to make a decent enough profit on the sale of their property. But the one thing that we've always told anybody who's looking at buying pre-construction, it's not a flip, it's not an assignment, it's not a get rich quick. It's a
long-term hold.
long-term hold. It's a long-term investor. And if they're not thinking 5, 10 years from the time of buying it, then this is definitely not something that they should be thinking about. And literally, from an investment standpoint, to anybody who's thinking about 2, 3 year horizon to make money in real estate, they should be looking at some other type of
Yeah,
investment strategy, because that's not how this works. And as we've seen, we can see markets shift really quickly one way or the other. If you're buying real estate and you're buying it as an investment, it needs to be with a long-term horizon.
yeah, agreed. Well, there's acquisition costs. You pay land transfer taxes when you
Yeah,
buy. When you sell, you pay real estate fees. So,
yes, you do.
you could be $75,000 out of pocket between those two fees. Your property needs to appreciate by that much, and hoping for that to happen over a short period of time is, I think is wishful thinking. But long term, that obviously starts to look much better.
And Jason, what do you when you're talking to clients or having conversations about, because we're talking more about the overnight lending rate and the
Yeah,
Bank of Canada, that more is directly affecting the variable, but there's also the bond market, which is a whole
yeah,
separate other beast onto its own. And that affects long-term
fixed rates.
mortgages, like,
Yeah,
fixed rates.
yeah,
So where are things there, and how are you advising clients, or what type of decisions are clients making between a
yeah.
variable and a fixed right now?
So I think if you look today, yields have been flat. This has already been really priced in. The expectations on this cut, started probably about a month ago. So fixed rates haven't really moved down. I think, as we get some more info from the Fed in the US and we see some forecasting talk about more rate cuts, that will probably push yields down a little bit further. So fixed rates haven't really moved that much. For the most part, plus or minus, I would say, shorter term fixed have been around 4% since the start of the year. 5-year fixed rates a little bit higher than that, but plus or minus, 20, 30 basis points, they've been up or down from that 4% mark. The conversation is definitely, as I've said multiple times on this, on the pod, it's not a one size fits all approach. I think it really comes down to risk tolerance. With prime going down, the variable rate to fixed rate gap starts to shrink. They're pretty close now for quite a while. Going
Yeah.
back the last couple of years, variable rates were much higher than fixed rates. And so I think clients naturally were shifting towards wanting the lowest payment. And so
Hmm.
that typically over the last few years meant a 3-year fix that was the most popular. If you look at it, variable rate obviously comes with risk. The risk with a variable rate is that rates don't go down. They could go up at any point in time. But the biggest possible payoff, if rates do continue to drop, you're able to take advantage of that. And that's the one benefit of the variable rate. The other big benefit of the variable rate, and again, getting back to not suggesting you time the market, but a variable rate does give you the ability at any point in time to lock into a fixed rate. So
Hmm.
you start to see rates trend in a way that you don't feel comfortable with, or maybe fixed rates just drop to a level and you say, I don't want to gamble anymore, I just want to convert. It does give you that ability. So I assume we'll probably see more clients looking at variable rates just now seeing this cut, especially with the expectations that we'll likely see another and maybe two. 3-year fix has been very popular. It's lower than the 5-year. 5-year is the most conservative approach right now. It obviously affords you some guarantees if rates do go up. It's not looking like that right now. But again, getting back to, if we look back from Jan 1 to where we're at today, it has been a roller coaster. Some clients just want to opt for the guarantees that go along with a 5-year fixed. I will say the longer the fixed rate term, the greater the penalty would be to renegotiate in the event we do see rates drop over the next couple of years. So I always tell clients, if you're going to take a 5-year fix, just be prepared that even if rates do drop, this is going to be your interest rate for the next 5 years, because any interest savings by negotiating a lower rate will likely be negated by the fact that you're going to be paying a pretty significant penalty to get out of it. So you've got variable rate with the most risk on one side, 5-year fix the most conservative. 3 years for some clients feels like they're splitting the difference and gives them an out to renegotiate sooner than that 5-year.
And Jason, are you seeing, what are the reports? Like we did a podcast last week, myself and Corey,
Yeah,
and we were talking about how somebody was reporting and it made the news. Somebody
yeah.
tweeted and made the news how there was an uptick in power of sales on MLS. I know our default rates are pretty low in Canada, especially comparative to the US. Are
Yeah.
you seeing any uptick in defaults, or are you having any conversations with clients being under duress?
So, and I said this last time we were on the podcast. I've not had a single client this year in all of 2025 that's up for renewal that's reached out to me that says they need to sell their house. So
For
there
that
definitely are
for that
client, yeah,
reason. For
yeah,
that reason.
due to financial stress.
Yeah.
Obviously, clients are selling for various reasons, but not because financially they need to. Um, Looking at it, I don't think it's a massive part of the market. I think the most recent stats show that 0.23% of mortgages in Canada are in arrears.
Hmm.
0.23%. It's a very negligible amount. It has been trending up, like slightly from 0.22 the previous report to 0.23. And I expect as unemployment increases, we'll probably see that. There's a direct, kind of correlation, obviously, to,
Yeah.
people being out of work and people going into arrears. But I also will say that I am seeing banks, for the most part, more willing to work with people. And
Yes.
we've talked about this before, prior to these, 2020, them, giving extensions on people and giving them, 6 months of not needing to make mortgage payments. Banks were very cutthroat. If you missed a
Yeah.
payment,
Oh, I
two
know.
payments, yeah, they had a pretty robust collections department and they were coming after you. But I've been seeing a much bigger willingness for banks to want to work with clients to figure out solutions on this. And so I assume that trend will continue. Where I see probably there being a big hit is if you go back to, again, always talking about 2020 and 2021, a lot of alternative type lenders,
Yeah.
they're typically much higher rate lenders, right? They
Hmm.
lend for higher risk, but at the point rates were so low, you could lock in for 5 years, even at 3.5% versus, the 1.5% a client might be able to get. Now those mortgages are all up for renewal, and some of those rates are 6, 7%. I assume there's probably some pain in those, with those lenders, but it's not a big part of the business that I do. I don't deal with a lot of alternative lenders. They're renewing clients at much higher rates, and that definitely will have a significant impact. Going from 3.5 to 6.5% is not great. And if you haven't taken the steps over that, 5 year period of time to put yourself in a better spot, whether it be credit repair, making sure your income numbers look better, and tough to repair your income the way that you can repair your credit, right? So you can only work with the numbers that you're making. So
For sure.
um, I assume that segment of the market will probably have a pretty big hit, and not pretty big, but it will have a much bigger hit than the traditional banks and mortgage companies that are lending to fully qualified clients.
And just interesting listening to what you were saying is it did remind me of in 2020, everyone was worried about this deferral cliff where all these people who
Yeah,
deferred mortgages, then all of a sudden, everyone thought that the whole thing was economy was going to collapse because nobody could afford to buy anything and
yeah,
everything was just fine. There's also been so much about this year where you had such a massive wave of renewals coming. The media was all over it saying, oh, there's a renewal cliff and nobody's going to be able to afford anything and the whole economy is going to collapse or the real estate market is going to hit an apocalypse. You
not
haven't
seeing it.
seen that. No.
Not seeing it. Again, I've not had a client that's been financially motivated to have to sell. There are solutions. Keep in mind also, I think it was 2018 when the stress test rate came into effect
Yeah.
and everyone hated it.
Yeah. I hated it.
Yeah, but if you look back now,
Yeah.
it's kept the mortgage market afloat. So
I agree.
everyone that's coming up for renewal qualified at a rate 5.25%. That was the stress test rate back in 2020. So everyone is qualified at an interest rate that's, percent, plus above where they're currently paying today. So in theory, they should be able to pay. And for borrowers that need to, for the most part, clients have built up equity. Maybe some condos being the exception, but if you bought a house in 2020, prices went up and have pulled down, but you're probably still ahead. There's enough equity for a lot of clients to be able to tap in. And if they need to maybe pay out some high interest debt, they can refinance. There's the ability also to re-amortize your mortgage. So you could take your mortgage, you start at 30 years, you've paid it down to 25. And I'm not suggesting everyone do this, to be clear, but
Mm-hmm.
in the event that you're really struggling financially, you could pull it back out to 30 years to give yourself some relief on the monthly payments as well. So I've had clients looking at solutions like that, but again, no one just flat out needing to sell.
And blanket appraisals. You were sending me some
Oh yeah.
text on that. You want to touch on that for a second? I find it really interesting.
Yeah, so a blanket appraisal, this goes back to the pre-construction market. And I think if you're looking at maybe, people that purchased in the peak, was the peak 2021, would you say,
Yeah.
or 2022? Yeah.
Yeah. Yeah.
Where, maybe things were, I don't know, 14 or 1500 a square foot. I'm just throwing numbers out there. And you've got all these clients that purchased at that price per square foot. Now the buildings are coming up for registration. They've been built. It took 3, 4 years to build. They went through the interim occupancy and now they are at registration. Well, those need to be appraised at today's values. And obviously we're aware that the price per square foot on a condo is not 15 or 1600 a square foot for the most part. So,
No.
you had a lot of
Almost
clients
half.
that were, yeah, a lot of clients that are in a tough financial spot where they need to either A, come up with the additional funds. So you bought a place for 600 and it appraises at 450. The builder doesn't care it appraised at 450. You owe them $600,000. That's the
Yeah.
reality of it. And, the other option, which isn't an option, but some people have been doing, is just walking away. And obviously that opens you up for, litigation down the road. You
Yeah.
know, you were in a legal contract. Um, so the financial regulator, OSFI, the Office of the Superintendent of Financial Institutions, recently said that, you know, they really are not going to get involved if banks are doing blanket appraisals. And what's a blanket appraisal? Some banks, like RBC, I know they've done it
Hmm.
for a few clients, instead of appraising at today's value, are using the value when the client's purchased. So, you know, keep in mind they may have financing on that on the construction side. So it's in their best interest to close on these properties. So they're not appraising based on today's current values. They're appraising based on what it was actually bought for,
Yeah.
which in some cases is 25% or more, you know, higher than what it's worth today. And so you've got them doing that, and there was big fear that they're going to get their hand slapped for this. How is this allowed? And the regulator said it's not their duty to interfere. And so you'll likely see in some cases banks do that maybe have a position that they want to cover on maybe the construction side, or trying to gain some share of kind of closing some new clients. But keep in mind they're closing those clients likely underwater, meaning they're holding a mortgage that's worth more than the property is. And keep in mind, if you're, buying something and if it's an investment, you have to have at least 20% equity in the property. So you can only borrow 80% of the value. And in some cases, they may be financed over 100% of what it's actually worth today,
Hmm.
which is crazy. But it does give an out for some borrowers who have new construction closings coming up. It is a
I, I
solution.
I actually think it's a de facto bailout for developers to get through this hump.
Yeah.
So it's interesting because people don't
Yeah.
talk about this too much, but it is something that's happening. And, you got to wonder, how are these buildings at 17, 18, 19, $2,000 a square foot closing? Well, and what would
That's how.
happen if none of these buildings close? So it is an interesting side of the mortgage financing condo market for new builds that doesn't get a whole lot of attention, but I do find it very interesting. And the fact that
Totally.
OSFI, which is just all over everything and all over everyone with all kinds of rules, in this instance, is just saying, we're
It's
not going to look
overstepping.
at this. Yeah,
Yeah.
we don't want to
Yeah.
overstep. We
Yeah.
don't want to
Totally.
overstep. But
Totally.
during the height of high interest rates, they wouldn't bring down the stress test,
Stress test.
and
Yep.
people were calling for it. So it'd be
There has been
interesting
some
to see.
chatter also about
Yeah,
stress test rates. Keep in mind, OSFI has a mandate to meet annually. I think they meet in December every year.
yeah,
And there have been some rumors floating around, and they're obviously just rumors, that there may be some changes to the stress test, or maybe they make it a bit more dynamic. So that would be interesting to see. Again, I was one of the people that was a fan of the stress test because it prevented you from being your own worst enemy as a client and taking
yep.
on more debt than you should have. So I think it served its purpose. So, but there is some possibility of it maybe even being removed and possibly tweaked if not removed. So that's something, kind of end of 2025, early 2026, we should have some more information on.
It's interesting to see because in the US, and generally what happens in the US sometimes follows suit here in Canada, but there's a lot of talk from the current US administration that they may declare a housing affordability emergency, and they're talking about all kinds of stimulative ways that they can make housing more affordable, from privatizing Annie Mac and some of these Fannie Mac and some of these larger
Yeah.
companies, to making mortgages portable with the sale of properties, to help people be able to move on who feel trapped and not having to want to renegotiate because you can lock into a 30-year mortgage. And so they're looking at a lot of creative
Yeah.
ways to bring affordability back to the market. And I do think we'll see some measures better than the last round from last year from the government that may help. So it's something to keep your eye on, because I do
Yeah.
think we're going to see more government meddling into the housing market to try and bring especially first-time buyers or those struggling to get into the market.
There obviously were a few measures, the increase to the RSP limit you can borrow, the FHSA account, the first home
Yeah,
savings account,
reverse
and then
mortgage.
obviously the CMHC
Yeah,
ability to put, but those they seem like band-aids. You know what I mean? You still have to have a pretty significant income to purchase, a house in the city. And, the affordability part of it's a bigger issue than making it a little easier to qualify for people.
For sure. I mean, the
Yeah.
best way to bring back affordability is to have an economy that actually grows. And so I don't think that is going to be on the agenda for the short term, but I do expect more meddling and more sound
Hmm.
bites and more policy changes, which may be somewhat helpful, but I guess time will tell. But it is something to keep your eye out for.
Yeah.
I do expect some tinkering on the financial side of things, on the mortgage side, lending rules side of things. So it'll be interesting to see how things play out. Jason, is there any sort of takeaways from this conversation that you want to leave any viewers with? People thinking about making a move or a purchase, like what
Yeah.
should they be looking at from a finance standpoint?
I think it probably makes sense if you were maybe pre-approved and were feeling discouraged, last year or early part of this year, to maybe reconnect with your bank or your mortgage broker, and maybe just have them rerun numbers, A, to see if you qualify for more, but B, more importantly, to see how the affordability has improved. With lower interest rates, obviously lower carrying costs. And so, you might be pleasantly surprised there. And I always do suggest, as I said earlier on this, on the pod, um, get yourselves pre-approved before you start looking for a home. Know your budget,
Yes.
stick to your budget, and don't go above that budget. That Draw that line in the sand. It's not meant to be with the house that you're looking for. Don't get carried away. And again, stick to your numbers. Yeah, I think that's everything. I think
Awesome.
obviously we've got another announcement coming up at the end of October, and I think it's going to be heavily data dependent. We'll continue to watch inflation numbers and employment numbers, and make sure that those are both, well, unfortunately, unemployment will be trending in the wrong way. Hopefully, inflation is trending in the right way. Sadly, it feels like we're going to continue to see an uptick in unemployment, and hopefully inflation cools, and that will open the door for both sides of the border for the central banks to cut rates.
Awesome. Jason, where can people find you?
www.outline.ca.
Amazing. Well, thank you so much for watching today. Please be sure to hit that like or subscribe button. I forgot to make the request at the beginning of this conversation, but please be sure to comment down below if you have any questions. We'd absolutely love to hear from you. Thank you so much for joining, Jason. Thank you so much for
Thanks as
being here
always.
today.